Hello, at the end of this video, you will unlock your understanding of what equity is. So what is equity? Equity is the residual interest in the asset of a company after deducting all its liabilities. When a company goes bankrupt, it sells its asset. The money is used to settle creditors, for example, banks, suppliers, etc. And what is left is distributed to equity holders. So we have the formula for equity to be asset minus liabilities. And equity in itself is made up of three components. We have the capital contribution, and in most of the financial statements of companies, you will see share capital plus retained earnings, which is the accumulating of the net profit of the company, and then minus the dividend. So the term equity is used in accounting as well as in home ownership. So we will start with what equity is in accounting. So I have discussed the accounting equation in one of my videos, so you can find it in the description. So go and watch it. So the accounting equation says that equity is equal to asset minus liability. So in this instance, we have a man who would want to start a lawn care business and he has only $10,000 and he wants to buy a lawn mower which costs $2,000, and because he has only $10,000, he went to the bank and then borrowed $1,000. So with his own money, 1,000, and then with a loan from the bank, he was able to purchase the lawn mower. So looking at the equation again, we can see that when you subtract this 1,000 from the 2,000, then you have the 1,000. So that is how it works in accounting. So when we move forward, so on the balance sheet, equity goes up when there is net profit, because the net profit will be added to the retained earnings and then it will increase the equity. And this, at the same time, when the company issues new shares, it also increases the share capital and hence the balance of the equity. And it goes down when there is a net loss, and which has also an impact on the retained earnings. It will reduce the retained earnings and hence the equity. And also when there is dividend payout, the equity also decreases. In home ownership, this is just the difference between the value of your house and then what is left to be paid to the bank or what you owe. So assuming you have the value of your house is 600,000 and then you owe 500,000 to the bank. So in that case, you have equity of 100,000. So this is a positive equity. So the difference between the value of the house and how much you owe to the bank is called equity when it comes to real estate. So since we have positive equity, we can as well have a negative equity. And this comes about when the value of the house is less than the amount that you owe. So for example, we can see here that the value of the house has dropped. So we have 480,000 and then what we need to pay to the bank is 500,000. So in that case, you can see you have a negative equity, and the decision is with the bank whether they would want to sell the house at 480,000 and then write off 20,000 in their P&L, or they will allow you to continue. That's the decision of the bank. And when you are at this stage, you need to discuss with your bank to see what will be the way forward. And this will be the end of this video, and I hope it helped you a lot. Please subscribe to my channel, and I'll be coming your way with more videos. Take care. Bye bye.